Warren Buffett's Berkshire Hathaway just released their latest Form 13F, which reveals every single move he made in his portfolio last quarter. So in this video, we're going to be reviewing all of his moves, talking about his massive cash position, and looking at some key takeaways. So let's go ahead and jump in. To start, let's simply talk about the different buys and sells. In the most recent quarter, Buffett added to 6 existing positions and opened one new one, which you probably know by now. It was Google, and we'll discuss this more later in the video. But he also reduced the size of 5 positions and sold out of one entirely, which was D.R. Horton. Number 2, we're also continuing to see that Buffett's cash pile is growing. It's grown substantially in just a couple of years. It wasn't too long ago, we can see around March of 2022, his cash position was around $105 billion. But after this most recent quarter, it's sitting at $382 billion. So we're talking about nearly a 4x in his cash position in a very short period of time, just a little over 3 years. Now, what is it that's been contributing to this cash position? Why has it grown so large? Now, remember, just 3 years ago, it was sitting at about $100 billion, and ironically enough, if we look at point number 3, Buffett is again a net seller of stocks. Warren Buffett has been a net seller of stocks for 12 consecutive quarters, which that means 3 years ago. So because of his continued selling over the last 3 years, we've seen his cash position grow substantially. In the most recent quarter, it's estimated he sold around $12.5 billion, and total buys was sitting at about $6.4 billion. Now, there's a few different reasons as to why that might be, but we have to point out a couple of different things. To start, what we call the Buffett indicator, the US stock market value to GDP, is sitting at its highest value really in its entire history. Historically speaking, this is how Buffett decided whether or not the market was over or undervalued. And on top of this, if we start digging into more data, this is a report from JP Morgan. Look at this chart over here on the right. What it's telling us is the forward PE and the subsequent 5-year annualized returns based on the historical data. So, for example, we can see as of October 31st, 2025, the S&P 500 PE multiple was sitting at 22.9. This is one of its highest historic multiples, as we can see here. And when we look at history, the average annualized 5-year returns, when it's sitting that high, is pretty much non-existent. It's around 0 to 1 or 2%, and in a lot of instances, even negative. If we look at the forward PE and subsequent 1-year returns, we can see based on the market's current valuation, we should be expecting low single-digit returns. Now, what the argument people who are bullish on the market would say is this doesn't account for the fact that we're entering a new era. AI has the potential to cause a massive surge in earnings. And that could absolutely be true, but the historical data is concerning nonetheless. But before we move forward, I want to say thank you to Famous.ai for sponsoring this video. Everyone in the investment world for the last few years has been saying how AI is going to change the world. And Famous AI is a really good example of that. This is one of the coolest AI tools that I've used so far. It allows you to take an idea to a working app or web page instantly. Whether you want to build a landing page for your web app, or build a SaaS for a mobile app, or even create your very own crypto project, Famous AI makes it possible to build your ideas fast, make them simple and scalable. It's an amazing vibe coding tool, and really you don't even have to know how to code to get started. For example, let's give Famous AI a prompt that will create for me a web page that is a portfolio website showing my skills as a developer, and I'll hit enter. Immediately, it will start building my app, and it's telling me exactly the steps it's taking to do exactly that. And after just a few moments, you can see it's built a completely functioning website for me. It's clear exactly what I do. It gives people the ability to book a call. For example, let's tell it to link to my X/Twitter account, Dividendology. We can now see when I scroll to the bottom, we have a link right here. And when we click on this link, where does it take us? Directly to my Twitter/X account. And we can easily take this from a web page on our desktop to see what it would look like on mobile as well. And publishing your website or your app or your crypto project is easier than ever. Just come up here and click publish. So Famous AI really is changing the landscape. So if you want to start using Famous.ai for yourself, be sure to check out the link in the description. Number 4 is analyzing Buffett's Google bet. Now, Warren Buffett was actually asked about Google stock in an interview from a few years ago, and I'm going to go ahead and play the clip.
Another stock that you mentioned over the weekend saying you should have known it early on was Google, Alphabet, the parent company of Google, because you knew how much they could charge you when it came to Geico.
Yeah, here we were at Geico paying them $10 or something for every click. I mean, $10, and no cost of goods sold. I mean, and it produced results for us. That's why we paid them the money. So I had seen the product work. and I knew the kind of margins. I mean, I always said it's great to find something that costs a penny and sells for $1 and is habit forming. This doesn't cost anything, and it's very useful. I mean, if you're looking up auto insurance on Geico, you've got an interest in auto insurance. I mean, it's a very directed way of talking to people. So the real question in my mind, I'd seen Alta Vista before. I used to play bridge on Alta Vista, and what I didn't know was whether there'd be more entrants. I didn't know enough about technology to know whether this really was the one that would stop the competitive race and all that. But I should have done Google too.
So as we can see, Buffett's been a fan of Google for a while now. And while we don't know his exact buy price, we know based on this recent 13F filing, the buy range was between $180 and $255 per share. So if we look at Google charted out over the last 5 years, the buy was somewhere in this range right here. Now, keep in mind, it's absolutely possible that this purchase decision was primarily influenced by Todd, Ted, or even the new CEO, Greg Abel. But with that being said, even though they didn't buy at rock bottom prices earlier this year, the average analyst estimate is still giving them about 10% upside with a price target of $312.50. Now, what's really interesting when we analyze Google stock is if we jump over to the sensitivity analysis and look at Google, what you'll notice is the average PE ratio is very close to the trailing 12-month PE ratio. In fact, it's only off by about 5%. And even if we remove this large outlier here in 2017, the current PE ratio is still off from the average over the last 10 years only by about 7%. So what does that mean? Well, it means despite the fact that Google stock in the last year is up 61%, year to date almost 50%, and in the last 6 months, nearly 70%. It means that trading at its current prices has simply put it back to its average valuation multiple. Now, why is that such good news? Well, it's great news because the earnings growth projections for Google look quite solid moving forward, with the average estimate coming in at 12.21%. So if we apply that average EPS estimate moving forward of 12.21% and then just apply the average PE multiple, sitting at around 27, we can still see the forward-looking returns can look quite attractive. By 2030, your compounded return is about 10%, which is still above historic market averages. And keep in mind that doesn't include dividends. This certainly isn't a best case scenario, but it's not a worst case scenario either. But the point is they're just now trading at their average historic multiple, which is great news for the people who want to see this stock continue to climb higher. It certainly still has that potential. Now, as we were looking at his holdings, one of the things you probably noticed is that Warren Buffett once again is selling Apple stock. If we come down here, we can see he reduced his Apple position by almost 15%, selling off about 41.7 million shares. And this was actually the largest move that Buffett made in the most recent quarter, as this was around a 4% change in total to his entire portfolio. The only other move he made that was even close to being as large was the Google buy, but the amount of capital moving on the sell was still significantly more. Now, a couple of years ago, Warren Buffett stated that the reason he was trimming his Apple position was for tax purposes, but it appears like it's going to be a bit more than that. In 6 of the last 7 quarters, Buffett has reduced his Apple position. Now, keep in mind, at its peak, Apple was sitting at about 51% of his entire portfolio, and as of right now, it's sitting at just 22.69%. Now, one of the things we have to keep in mind when it comes to Apple stock is look at the price movement really in just the last 3 months. If we look at where they were trading maybe around mid-August, it's around $200 a share, but now it's at about $267.44. Now, this is worth noting because last quarter, Apple was only 22.39% of its portfolio, but it's now sitting at 22.69%. So even though he reduced his shares, his total Apple position is actually a larger allocation of his entire portfolio because Apple's done so well in the last 3 to 4 months. Now keep in mind, Apple still has a lot of quality metrics. If we look at Apple on the stock screener, one of the things you'll notice is yes, revenue per share has been growing, earnings and free cash flow per share have been growing, but the organic growth has not been nearly as high as a lot of people think. In fact, if we look at revenues over the last 4 or so years, it's been relatively stagnant. Now, last year was a record at about $416 billion, but the 3 years before that, it was pretty stagnant. 2022 revenue was higher than it was in 2023 and 2024, but despite this, if we look at revenue on a per-share basis, it continued to climb every single year. Why is that the case? Well, it's because Apple is a share buyback machine. I mean, there's not many companies buying back as many shares as Apple stock. In 2015, they had about 23 billion shares outstanding, and by 2025, it was down to under $15 billion. So remember, every time a company buys back its stock, every time it buys back its shares, it's going to automatically boost all of the other per share metrics. So earnings per share gets a huge boost, revenue per share gets a huge boost, free cash flow per share gets a huge boost, and it can even help the company sustain and increase their dividend payouts. Now, the caveat to that is if a company is buying back its own stock at overvaluations, then it can actually hurt shareholder value. Now, with all that being said, we can still see Apple has some quality characteristics, such as the fact that its margins have expanded by a lot in the last few years. The 10-year average gross profit ratio is at 41.3, when last year's came in at nearly 47%. So if you're buying back stock, growing revenues at just a decent rate, but you're also expanding your margins, you're going to see a lot of EPS growth. And in 2020, it came in at 331, 2025, 749. So more than a double in just a 5-year time period. On top of this, return on invested capital for Apple is absolutely exceptional. They now have 4 years in a row where ROIC has been above 40%, and this is one of the highest indicators of a quality company. Again, remember, as a baseline, we want to see around 10%. High-quality companies can often achieve 20%. It's basically just telling us how profitable are the projects the company is putting their capital into. So Apple's certainly not without its problems, but there are some good things happening over with Apple. Number 6, Berkshire Hathaway's outperformance is dwindling. If we look at the historical performance, what we can see is Berkshire Hathaway has outperformed the S&P 500 in every single decade since the 1960s. That's a pretty mind-blowing stat. But if you look at the annual outperformance over here on the right, every single year it seems to be decreasing. And really, this is the law of large numbers kicking in. The more money you have to manage, the more difficult it becomes to outperform. Now, Berkshire Hathaway has outperformed the S&P 500 in the last 5 and 10 years, but the last 3 years have been a different story, mainly because Berkshire Hathaway doesn't have a lot of exposure to the Mag 7 stocks. Yes, they've had Apple, but they just recently initiated their position in Google. So again, very little exposure to Mag 7, which has been driving nearly all the market returns. The S&P 500's total return in the last 3 years is about 67%, Berkshire Hathaway 62.3%. Number 7, buy the dip. Now, this is actually really interesting. We've seen Buffett shock investors when he bought United Health Group just a couple of quarters ago. He bought Google at lower prices, but if we look at these other stocks that he's adding capital to, like Chubb Limited, Domino's Pizza, Lamar Advertising, many of these are companies that are actually in the midst of a dip right now. And we hear about the strategy, just buy the dip all the time, but there's actually a lot of data behind this. What we can see here over all the way on the left is the max drawdown for a stock. So for example, stocks that fell back 50 to 55%, they made their way back to par value 77% of the time. That's an incredible statistic. Even stocks that fell 60 to 65% made its way back to par value 67% of the time. And stocks that fell 70 to 75% of the time found their way back to par value 62% of the time. So I know a lot of people don't realize this, but there's a lot of data behind buying the dip. Now, we have to be strategic about it. Obviously, we have to buy high-quality businesses. But if Buffett finds a business that he likes and it continues to fall, he's not afraid to continue to add capital. At number 8, Buffett is still betting on financials and tech. So yes, he did trim positions in companies like Bank of America and Apple. But if we look at his allocation by sector, he still heavily favors those positions. It makes up nearly 65% of his entire portfolio when you combine financials and technology. The only other 2 major sectors really are consumer staples as well as energy. Point number 9, we're just going to analyze Buffett's portfolio. Now, the top 3 positions in Buffett's portfolio make up around 50% of the entire portfolio. That's Apple, American Express, and Bank of America. So that's really important to keep in mind. But then we have a few other major positions, such as Coca-Cola at nearly 10%, Chevron at 7%, Oxy at about 4.68%, Moody's 4.4%, Chubb Limited 3.31%, Kraft Heinz at 3.17%, and then Google now 1.62%, which is the 10th largest position in his portfolio. There's plenty of other smaller positions in this portfolio that are worth less than 1%. And at number 10, we have Warren Buffett's final goodbye. This was a news release that Berkshire Hathaway just released a little over a week ago, and it was Warren Buffett's last message to shareholders. It's certainly full of plenty of gems, and I enjoyed reading it myself. And I've included a link to the entire letter in my newsletter, which I'll put a link to in the description. So go ahead and let me know what you think of all of Warren Buffett's final moves. And again, like always, don't forget to like and subscribe to the channel.